What's going on, guys? Welcome back to another video. In this video, we're going to be going over all of the companies that I am looking at to trade for earnings this week. We're going to go over exactly what the market is pricing in, what exactly the different strikes that I am going to be looking at are, and a little bit of some option strategies on how to trade these events. So if you enjoy all the information that I provide you in this video, please go down and hit the like button and hit the subscribe button. It really helps me get this information out to as many people as possible. And you get to stay up to date on all of your favorite stocks and learn about a couple of new ones. So the first company that I am looking at for this week is AMD Advanced Micro Devices. I've held this company for a long time. I really like it long term. I think I got in at around the $12 to $14 range a couple years ago, and this company's been absolutely doing great for me long term. But they have their earnings coming up this Tuesday, and as we can see by this chart, on January 11th, the company was trading at about $98 and fell all the way down to the $88 range. So we really have not seen the typical earnings run-up that we usually see for extremely volatile companies that could move a lot on earnings like AMD. Now, if we come over to this Google sheet right here, I've gone ahead and exactly calculated what approximately the market makers are pricing in for AMD's earnings. So right now it is pricing in about 8.7%, which is going to be plus or minus $8.05 in any direction. So basically what this means is that this is what the market is expecting the move to be after AMD releases its earnings numbers. Now, if you've watched my other options trading videos on my favorite strategies to trade earnings, usually I look for companies that are pricing in anywhere between 3 and 6% because I like to buy contracts that are double what the market is expecting. So let's say this $8.05 number was actually like a 4% out of the money, and that's what the market was pricing in. I would buy contracts that are $16 out of the money each way. Anywhere above 6% that's what the market's pricing in my opinion, is going to be too much for this strategy. Now, you can get lucky and the stock will absolutely go crazy in one direction after they announce their earnings, but that's just too much risk for me in this strategy. So if we take a look at Microsoft is actually pricing in a pretty good amount. They're pricing in about 4.5%, and that's going to be plus or minus $10.1, and that's going to be $20 out of the money each way. So let's take a look at the exact contracts that I'm going to be looking at. So if we take a look at what Microsoft is trading at right now, it's trading at about 226. So $20 out of the money on the call side would bring it to 246, which in order to purchase these contracts, I would either go with these 245s for 80 cents each, which would cost you $80 per contract, or 67 cents each, which would be $67 per contract. And then if we come over to the put side, we would go down and we would basically go to the 205s, and these are going to be a lot cheaper, so you can actually get closer to the money on the put side if you would like. You can actually get the 210s, which I think would be a good idea. Now, if these contracts go in the money, this is going to be a massive gain. So you would turn each $57 that you would put into this trade into around $400 to $500, maybe even $700. That's why I like this strategy, because you can be wrong a lot of the time with a little amount of money, but once these plays hit, you make a lot of money. And in order to break even, only one side of your strangle needs to go up 100%, and then you can close out the trade and there's no blood drawn, and you can break even on your entire trade. So let's take a look at the next company that I'm looking at. This is going to be Texas Instruments Txn, and they're pricing in about 5%, or plus or minus $8.58. Now, I would usually do probably $17 or $16 out of the money each way. So let's take a look at TXN. If we come over here and type in TXN, we can take a look, and we're going to do the puts first. So 172 minus 16 is going to be about 165-ish, or 164, or 154. I'm sorry, my math is terrible. So we're going to take a look at these contracts right here, these 155s. I think these are actually a good option to trade on the put side because you are only spending about $37 a contract. Now, if we go over to the calls, we're going to take a look at the 180 187s, one right here, $55. This is a great company to trade this strategy on. It's not pricing in an absolutely crazy amount. And if it goes crazy in one direction or the other on the weekly expiration, each $55 you put on each side, if it goes in the money, will turn into a $400 return, which is absolutely amazing. But it would have cost you about $100 to do this trade, which is still about a 300% return, which is absolutely amazing when you're trading options. And you can use those profits to put more money into your long-term positions. So let's take a look at some of the other companies. We have Apple pricing in 6.4%. That is just outside of what I would like to trade for earnings. Now, I've hit Apple a couple times before. In August, there was a trade on Apple's earnings that went absolutely crazy when they announced their stock split. I had a out the money strangle on each side, and that play went absolutely crazy. I think it was 4,000%. But I think we're going to need to wait and see on Apple. Now, these pricing in numbers are going to change. So what you do in order to calculate this is you add up the at the money put and call and divide it by the current trading price of the stock. So that's how I'm getting these percentages. And then this is going to be plus or minus 8.87 or $17, $18 out of the money on each side. So we're gonna put Apple on the back burner. We're gonna keep calculating what the market is pricing in throughout the week and see probably within 15 minutes before the close, right before Apple announces their earnings, if we want to play Apple. So next up, we're going to have Boeing, and Boeing is actually an interesting company. Usually their premiums are super high, but they're not pricing in that much for this earnings announcement. They're only pricing in 5.2%, which is going to be $10.77, about plus or minus each way is what the market is pricing in for the earnings move. So in order to go 2 times that, we would need to go about $21 to $22 out of the money on each side. So if we take a look at these contracts, we're going to be able to buy the 225s or the 227s for about $80 to $60, depending on which contract you would like to go for. So if you see a trend in this pattern, we're buying contracts that are pretty cheap, but have a pretty good chance, if the company actually has a really good or really bad earnings announcement, to go in the money. So you can buy more contracts on each side in the hopes that they're going to shoot in the money the next day or two, and you're going to make an absolutely crazy return if you hit one of these companies. Now, I usually try to aim for 2 out of 10 or 1 out of 10 to hit these companies, because every once in a while you'll hit a 4,000% play and you'll be able to finance all of your other options trades with just one trade. So these are low probability, high profit trades. So you just got to be very careful when you're trading these companies. Now, if we take a look at the next one, we're going to do Facebook. Facebook, in my opinion, is pricing in too much. 7% is pretty ridiculous. The contracts are going to be super expensive. When you see anything above 6%, you're not going to be able to get any cheap contracts on the options chain, which is not great in my opinion. I like to buy cheap contracts, not spend a lot of money, but have the highest profit potential possible. And the same thing we can see with Tesla, but you guys probably already knew that. When Tesla has earnings, the implied volatility goes absolutely crazy. If we actually go over and take a look at the options chain, the Tesla implied volatility for this earnings is going to be pretty crazy. Yeah, so 80%. It's not as high as I thought it was going to be. NEOs are usually pretty higher, or Palantir even has a higher implied volatility. But either way, these contracts are, even the at the money contracts are $3,500 a contract, and you can't get anything under even like $3. You'd have to go out to the $1,000 strike at the end of the week, which is absolutely crazy. Now, if you want to gamble, by all means, buy these super deep out of the money Tesla calls. If you have enough money to do this, I'd say go for it. But in my opinion, playing Tesla for earnings usually doesn't end well. So that's going to be it for this video. If you guys enjoyed what I had for you in this one, please go down and hit the like button and hit the subscribe button. And if you have any questions about these different option strategies, please comment down below. I'll do my best to answer all of your questions. And if you have any additional questions, or you want to see these 2 option strategies in detail, make sure you go watch my other option strategy video. It's in one of my playlists. So if you want to learn more about options, make sure you go and watch those videos. So I hope you guys are excited for a very eventful trading week coming up. It's earnings season. This is my favorite time of the year to trade. There's a lot of money on the table for you to take. and I hope you guys can make a lot of profits this week. So thanks for watching, and I'll see you guys in the next video.